Today, I wanted to talk to you about something that a lot of people try to do. There's a lot of content out there, but wanted to give you my perspective as an advisor that's working with people with 1 to 10 million predominantly in investable assets, and that is timing the market. Something we'd all love to do, but is extremely difficult. So I wanted to give you 3 traps that we see often, as well as my perspective. And I wanted to kick things off with a tweet that I saw recently. It was from the author of Rich Dad, Poor Dad. He's wildly successful. I'll link the tweet in the comments. He said in April of this year, so right before Liberation Day, this got millions of views, and he went on to say, "I should not say this because it's not cool to say, 'I told you so.' Yet I did tell you so." In his Rich Dad prophecy book, I warned the biggest stock market crash in history was going to wipe out the financial security of millions of investors, especially my generation, the baby boomers. The stock market crash arrived today, and we are definitely in a recession, and more than likely a depression. Obviously, stuff like that gets a ton of clicks, ton of views. And so I went in and looked at what the S&P 500 has done since that date, since April 4th of this year, and it's up 31.59% since then. So it just goes to show timing the market is extremely difficult. So I want to hit on 3 traps that we see. And the first one being the illusion of perfect timing. And we've all seen headlines where, like, if you miss the 10 best days in the market, it dramatically slashes your returns, sometimes as much as half. So missing those big days, like post-Liberation Day that started middle of April of this year, or if you look back to COVID in 2020, we had the massive drawdown in January, February, March. If I remember correctly, the market bottomed around March 23rd of 2020, and then went on an absolute tear for the next year and a half. So if you had missed the end of March and potentially some of April even of 2020, your returns look wildly different. It doesn't make staying in the market that easier, but there is a reason to stay in your seat, as they say. Another trap is just the emotional trap. People don't usually buy lows or sell highs. They do the exact opposite. So they buy when things feel safe, and that's usually at the top or near the top. And they sell when fear is highest. And so this is something that I felt with my clients that were worried at the beginning of this year. And so the time to rebalance and evaluate and talk about your risk is during the good times, not when you're in a market correction and the market's down 20%. That's not the time to de-risk the portfolio. That should have been done at all-time highs and getting in a allocation that is more appropriate. Another trap is the time in the market versus timing the market. This is something that us financial advisors love to hit on because it's easy to conceptualize. Warren Buffett said it better than I ever could, and that is the stock market is designed to transfer money from the active to the patient. He's got a number of other great quotes, but the time in the market versus timing the market is a great way to think about things. And then one other one, a better alternative is like what I just hit on, adjusting your risk profile in the good times and having those conversations, making sure that you have appropriate levels of cash, that you can weather the storm. If you've got a year or two's worth of cash in your bank account, say you're a retiree, and you hit a market downturn, you're less likely to panic or be concerned if you've got all of your basic needs, your house paid off, whatever it may be. You're not as worried in that situation, and understand that this is what markets do, and this is why you prepared financially for it. So that's something that we've seen, dollar cost averaging, for those of you that are still working. If you're actively contributing to a 401k or saving in like a brokerage taxable account, and you're putting money on a regular basis, while the market correction sucks to go through and nobody enjoys it, it does offer you the ability to buy at discounts. So just that simple reframing can often be extremely helpful. So that's really what I wanted to hit on today, was how to think about market timing for those with 1 to 10 million in investable assets. And look forward to seeing you soon. Thank you for watching, and I will see you next week.